Consumer stocks plummet, down nearly 5% this week, with a bearish trend in low RSI of 38, signaling potential oversold conditions. Inflation risks are escalating. This is what every serious investor needs to know about consumer right now. Stay with me. Welcome back, or welcome if you are new to Financial Market Oracle. As we begin this week of June 8 to June 12, 2026, the overall market context is one of normal conditions, with the VIX at 19.6, indicating a relatively calm environment. Within this context, the consumer sector is worth examining closely, particularly as it has underperformed the S&P 500 this week. The sector ETF, XLY, has seen a decline of 4.97%, which raises important questions about its current trajectory and potential for future performance. This sector deserves attention right now because it is a significant component of the broader market and its trends can have a ripple effect on the economy. The combination of its recent underperformance and its importance in the market landscape makes the consumer sector an intriguing area of study. As we delve into the details, it is essential to remember that this is educational content and not financial advice. Let us start with the technical picture and what the charts are telling us. The consumer sector, as represented by the XLY ETF, has been experiencing a notable decline, with a weekly change of negative 4.97% and a monthly change of negative 4.18%. The RSI reading of 38 implies that the sector is in a bearish territory, with potential for further downside momentum. This reading suggests that the sector is oversold, which could lead to a consolidation or a potential bounce in the near term. The trend direction is clearly bearish, with conviction, as the sector has been consistently making lower highs and lower lows. Key support levels likely exist around the recent lows, while resistance levels are likely to be found around the previous highs. The current move does not appear to be a sustainable breakout, but rather an extended overreach to the downside. The technical setup worth watching this week is the potential for a bounce off the support levels, which could lead to a short-term consolidation. However, without a significant shift in momentum, the sector is likely to remain under pressure. Now let us look at the fundamental catalysts driving this sector. The consumer sector is poised to be influenced by several key factors this week, as we consider the fundamental drivers that will shape the performance of retail, autos, travel, luxury, and discretionary names. The upcoming CPI inflation report will be closely watched, as it has significant implications for consumer spending power and behavior. Despite some potential headwinds from inflation, the sector is likely to benefit from the ongoing recovery in consumer confidence, with key stocks such as AMZN, TSLA, HD, MCD, and Nike providing important signals about the health of the sector. These stocks are generally indicating a positive trend, with some companies continuing to demonstrate strong sales and profitability. Looking ahead, there are no major earnings reports scheduled for this week, but regulatory news and macro data could still move the sector. The longer-term fundamental thesis for the consumer sector remains intact, driven by the likelihood of sustained economic growth and the ongoing shift towards experiential spending. With the VIX at 19.6, market conditions are currently characterized as normal, which should support the sector's overall performance. Please remember that this is educational content and not financial advice, as we analyze the probabilities and themes that are shaping the consumer sector. Next, let us talk about the specific risks you need to manage this week. The consumer sector faces significant risks this week, primarily driven by concerns over inflation, interest rates, and consumer spending habits. Given the current volatility environment, with the VIX at 19.6, investors should be cautious with position sizing, as even a moderate increase in volatility could lead to substantial losses. Unexpected headwinds, such as supply chain disruptions or geopolitical tensions, could further exacerbate the situation. To manage downside exposure, investors should adopt a disciplined framework, focusing on diversification and hedging strategies. This may involve allocating a smaller portion of their portfolio to consumer stocks, while maintaining a cash reserve to take advantage of potential buying opportunities. By doing so, investors can mitigate potential losses and position themselves for long-term growth. And now for the strategic outlook, where does consumer stand heading into next week? This week we maintain a cautious stance on the consumer sector due to rising inflation and interest rates, which may impact discretionary spending. A key theme to track is the potential shift towards value-oriented consumer goods. Remember, this is educational content and not financial advice. For more market insights, like and subscribe to Financial Market Oracle and comment your consumer watch list below. Until next week, stay informed, stay disciplined, and stay profitable. Cheers! This video is for educational and entertainment purposes only and does not constitute financial advice. Always do your own research before making any investment decisions. Past performance is not indicative of future results.